Well, hello there. This is Gemini.
Welcome. Let's delve into a fascinating question in managerial accounting. How can two perfectly legitimate accounting methods result in dramatically different profit figures for the very same company's performance? Today, we're going to conduct a rigorous examination of two key inventory costing methods, absorption costing and variable costing. Our goal isn't just to define them, but to truly dissect their mechanics and understand the profound impact they have on managerial decisions.
Here's the roadmap for our discussion. We'll start with the single fundamental difference between these two methods. Then we'll put them into action with a concrete numerical example. From there, we'll reconcile the different net incomes they produce, explore the, let's call it a dangerous incentive one method creates for managers, and finally, we'll make a case for which method serves as the superior tool for internal decision-making.
All right, let's begin. To really appreciate the downstream effects of these two costing systems, we first have to establish their core conceptual difference. And you'll see, it all comes down to the treatment of a single type of cost. First up is absorption costing, which you might also hear called full costing. The name is quite descriptive. The product is made to absorb every single manufacturing cost. This means direct materials, direct labor, variable overhead, and, this is the critical part, fixed manufacturing overhead. It's important to note that this is the required method under generally accepted accounting principles, or GAAP, for any external reporting.
Now, in the other corner, we have variable costing. And just as its name suggests, it only considers variable manufacturing costs as part of the product cost. So what happens to fixed manufacturing overhead? Well, it's not attached to the inventory at all. Instead, it's treated as a period cost, meaning it's expensed entirely in the period it's incurred, just like your monthly rent or administrative salaries.
So, let's just crystallize this, because this is the whole game right here. The core distinction is the treatment of fixed manufacturing overhead. Under absorption costing, it's a product cost. If a unit isn't sold, that piece of overhead cost stays with the inventory on the balance sheet. But with variable costing, it's a period cost. It hits the income statement immediately and in full, no matter how many units you sold. This single difference is the engine behind everything we're about to see.
Okay, so much for theory. Let's see how this plays out in the real world. We're going to apply these two methods to a data set for a hypothetical company we'll call Premium Products to really quantify the impact.
Here's our data for the period. We've got our costs and prices, but I want you to focus on two numbers in particular. Our fixed manufacturing overhead is $120,000, and most importantly, notice that the company produced 30,000 units, but only sold 20,000. This gap between production and sales is the catalyst for the entire divergence we're about to calculate.
Let's start by preparing an income statement using the method that's required by GAAP, absorption costing.
The first order of business is to calculate the cost of a single unit. We simply sum the variable manufacturing costs. That's $5 for materials, $3 for labor, and $1 for variable overhead. Then comes the key step for absorption costing. We allocate the fixed overhead. We take the total of $120,000 and divide it by the 30,000 units produced. This gives us $4 of fixed overhead per unit, bringing our total unit product cost to $13.
With our unit cost in hand, we can build the income statement. Sales are straightforward. 20,000 units sold at $20 each gives us $400,000. Next, we subtract the cost of goods sold. Now that's the 20,000 units we sold multiplied by our $13 unit cost for $260,000. This leaves a gross margin of $140,000. Finally, we subtract all the selling and administrative expenses, and that gives us our bottom line.
Under absorption costing, Premium Products would report a net operating income of $85,000. Please keep that number in mind.
Now let's run the exact same numbers, but this time through the lens of variable costing, the method managers often find more useful for internal analysis.
The unit product cost calculation here is much more direct. You see, it only includes the true variable costs of manufacturing, materials, labor, and variable overhead. We completely exclude the fixed overhead from this calculation. So our unit product cost under this method is a clean $9.
The income statement itself also looks a bit different. We start with sales, but then we subtract all variable costs, both the cost of goods sold and the S&A expenses, to arrive at a very important subtotal called the contribution margin. This $180,000 figure tells us how much money is left over to cover our fixed costs. From that, we subtract all fixed costs for the period as a single lump sum, totaling $135,000.
And that leaves us with a net operating income of $45,000. Now that is a stark contrast to the $85,000 we just calculated under absorption costing.
So, we have a $40,000 difference in profit. This isn't a mistake. It is the logical, predictable, and entirely explainable result of how each method treats fixed costs. So let's reconcile it.
This table really says it all. Whenever production is greater than sales, as it was in our example, absorption costing will report a higher income, and the reverse is also true. The reason is simple. Under absorption costing, a portion of the period's fixed overhead gets deferred in ending inventory. In our case, we have 10,000 unsold units. Each of those units is holding on to $4 of fixed overhead in its cost. 10,000 units times $4, that is precisely our $40,000 difference in net income. That cost hasn't vanished, it's just sitting on the balance sheet, waiting.
Now, this mechanical difference isn't just an interesting academic exercise, it actually creates some very powerful and potentially very destructive incentives for management.
And this quote gets to the very heart of the problem. If managers are evaluated and, more importantly, compensated based on the net income reported under absorption costing, a path opens up for them that influence that number, not by selling more, but simply by producing more.
The logic is actually quite simple, and that's what makes it so tempting. If a manager needs to hit a profit target to get a bonus, they can just ramp up production. Each new unit that's produced absorbs a little piece of the total fixed overhead. So, by overproducing, they are literally moving costs from the income statement, where it would reduce profit, to the balance sheet, where it's hidden away in inventory. This makes the current period's net income look artificially high, even if all those extra units are just gathering dust in a warehouse.
And it's precisely because of this potential for distortion that a strong argument can be made that variable costing is a far superior tool for a company's own internal management and decision-making.
The advantages are really quite clear. Under variable costing, net income isn't affected by changes in production levels, it's driven by sales. This gives a much more honest picture of a period's performance. It also fits perfectly with cost-volume-profit analysis, a foundational tool for planning. Essentially, profit moves in lockstep with sales, which is what you'd intuitively expect. And finally, the income statement format itself, by separating fixed and variable costs, provides much clearer data for planning and analysis.
So this brings us to our final and I think most critical takeaway. While GAAP mandates one method for the outside world, true leadership requires a deeper understanding on the inside. If the primary number you show to investors can be influenced by simply making more stuff, regardless of demand, it forces us to ask what internal metrics should a leader truly rely on to gauge the actual operational and financial health of their business.